Okay, good morning. How's everyone doing this morning? All right, that wasn't so good. Good morning, Las Vegas. Good morning. All right, fantastic. Everyone can hear me okay? All right, fantastic. So good morning to everyone again. My name is Jeffrey Tesch. I'm the Managing Director of RCN Capital. I'm going to be doing a presentation today on how to make more money. Is anyone interested in making more money? All right. So thanks for everyone getting up nice and early. This is early on Vegas time, but I really appreciate it. And away we go. Looks like I'm going to have to stand on the stage as the clicker won't work otherwise. All right. So we're going to give you the whole kit and caboodle, and we're going to take some questions at the end. So, bad news for brokers. What does that mean? Well, at the end of the financial crisis, the independent mortgage professional, the lifeblood of America's residential housing financing system, went from 30% of all originations to 12% in 2016. Unacceptable. Thank you, Dodd-Frank. Chris Dodd, the fine senator from Connecticut, Barney Frank, the esteemed House of Representatives from the great state of Massachusetts, had a plan. Their plan was, let's figure out a way to regulate ourselves to the point where the independent mortgage professional could barely keep up. More stringent lending rules, rigid guidelines, thousands of complex regulations that the independent mortgage professional was just virtually put out of business. But we did survive. Where do you go when looking for new opportunities? Limited product options, ramped up regulations. Today, we are going to talk about building your reputation with a product that offers more flexibility, better service, more lucrative loans. At the end of the day, we are going to help you make more money on every transaction. And the best part, much faster closings. This new source of funding is a commercial loan. Now, commercial loans, you say to yourself, well, that's scary. I don't want to originate loans on big warehouses and malls, and that's not what I do. I'm a residential mortgage broker. But today, we're going to talk about commercial lending in the single family 1 to 4 space. Commercial loans on residential homes, a non-owner occupied opportunity. We are going to teach you how this product works and how you can integrate it into your current business plan. So what are these programs? How can they be used? Very simply, they can be used to acquire the home. They can be used to acquire the home and fix the home. We can also use these products to refinance somebody who's holding a single family home for investment purposes and cash out. Believe it or not, a tremendous number of people across our nation own homes free and clear that they are renting out, and they have no mortgage on them. Debt equity. So what about these loans? They're very different than the traditional residential world where you folks are constantly originating to a box. That box is very stiff and very unforgiving. How many times have you had the conversation with your customer? Well, why didn't you make your Macy's payment 3 months ago? You just blew up your ability to buy a house. That is a conversation that does not happen in the commercial residential world because there's not the rigid lines. Every single borrower is evaluated on how the deal itself is going to work. Private lenders are interested in whether or not that customer is going to make money on the transaction. I don't care if they paid their Macy's bill late 3 years ago, 2 years ago. It's got nothing to do with what we're talking about. It's a complete separate idea. It's a whole new way of thinking about lending. It really can be a game changer for individuals that are self-employed and individuals who got beat up in the crisis. Speed is everything in the private lending world. And the reason is most of these contracts are signed with very strict deadlines. It could be a foreclosure, it could be a short sale. It could be just an opportunity somebody wants out and they want out now. Most of these loans close within 30 days. Many of these loans, believe it or not, close in as little as 10 days. It's just a completely different way of doing business. So, how do we do things at RCN Capital? We're a fairly good-sized organization. We have an office here in Nevada. We have an office in Connecticut. We have loan officers. What we do is we assign that loan officer to the mortgage professional, to the mortgage broker. You're dealing with one person all the time, and that's the way it should be. No matter what product you're selling, you should have a point of contact that you can rely on. And that's what we do at RCN Capital. It's extremely important that you have that personal relationship. So what does this mean? It means that you have funding options for deals that don't fit traditional guideline. Now make no mistake about it, we're not talking about owner-occupied homes here. We're talking about investment potential. We're talking about customers who are buying a single-family home and they're going to use it for a business purpose. They're either going to fix it and sell it, or they're going to fix it and rent it out for income. The deals that you've been turning away over the years because you haven't had a place to put them are over. We're going to solve that problem today. And I'm going to mention brokers throughout this presentation because brokers truly are the lifeblood of our company. We don't have offices all across the nation with a retail presence. We rely on independent mortgage brokers to bring us those deals. Last year, 76% of all loans that we originated, we paid a referral fee to a mortgage professional on. They're everything to us, and we treat them with respect, and we treat them with great care. So how does it work? How does the broker referral program work? Many independent professionals broker these loans in what we call heavy involvement. The heavy involvement means the broker collects the docs as you would in your regular residential business. We're very document light in the private world. What do we require? A 1040, a bank statement. We run credit and background, a rehab list, if it's going to be a fix and flip, and that's about it. Because at the end of the day, it's the appraisal that's going to tell us everything we need to know about that customer. That's how we close these loans in such a short amount of time. So many folks like to do heavy involvement. So they collect the docs, they work with the corresponding loan officer at RCN Capital, and we split the origination fees. Origination fees in the private lending world are usually around 2 points. Can be more than that, could be 3. We split them all 50-50. For folks who don't have the time or aren't interested in broking loans directly and just want to make a simple referral, we do minimal involvement, where depending on the size of the loan, we'll just pay a referral fee, and then we'll take it from there. How do we qualify a loan in the private lending world? What makes it different than the residential world? Well, as I stated, it's all about the asset. So what the first question is that we want to understand is, what is the exit strategy? How does this borrower plan on making the loan paid off in a quick amount of time? Most folks are going to buy and then sell. If they're going to hold it for rental income, then it's going to be a refi strategy, which is often an opportunity for folks to go ahead and get a second loan with the existing customer. We look at borrower experience, we look at credit. Credit's not a big deal for us. We're interested in 600 and up, which sounds like a crazy low score, but the reality, again, it's all about the asset. We look at market saturation levels. And then we want to see if there's any leases on the property and if there's cash. Cash is everything in our business. The borrower needs a certain amount of money to be able to put down, and the borrower needs a certain amount of money to be able to fund the interest payments over the life of the loan. So we're going to get into the products now. We're going to talk about each of the different products that mortgage brokers sell across the nation and how they work. First one is just a straight up residential purchase. Now, this residential purchase is going to be for investment purposes, as we've discussed. This particular product does not have a rehab component. So it's on a single family 1 to 4. It's going to be a 12-month note. It's going to be interest only during those 12 months. So the borrower is only responsible for making interest payments while the loan is existing. We go all the way down to $50,000 up to $2.5 million. And believe it or not, there's a fair amount of properties across our nation that people are buying on a regular basis between $50,000 and $100,000. Now, they're not in California, but they are out there, and there is money to be made. As far as the qualifications, loan to value, we go up to 85% of the purchase price. If they're going to refi out, up to 65%, and if they're going to do just a cash out, we go out 50% out. FICO, there's no minimum on this at all. So let's run through a scenario on how this particular loan would work. So let's say the borrower's buying the property for $125,000. They're funding the renovations with this particular product out of pocket, $25,000 out of pocket. Their credit score is 600. They have very limited experience. They would qualify for a rehab cash now loan. The 12-month loan would go up to 85% of purchase. Borrower would fund out of pocket. The down payment would be $18,000. Closing costs $10,000, inclusive of 2 points to RCN Capital. Now, when you see those 2 points to RCN Capital, those are split 50-50 with the referring broker. Even on a small loan like this, you can see how the profit potential in this business is huge. The referral business for independent mortgage professionals is tremendous. And the beauty of loans like this is they close very fast. This is really the bread and butter product in the fix and flip world. This is by far the most popular loan that RCN originates. And it's what's known as the after repaired value loan. So once again, the collateral is a 1 to 4 family that's non-owner occupied. It can be any house, anywhere. It doesn't make a difference to us. All 50 states. Loan to value, up to 85% of the purchase price, and yes, 100% of the renovation cost. So let's stop there for a second. So when the borrower comes and they say, well, I don't have a tremendous amount of money and I'm going to need to fix this house up, what we're looking at is, what is that house going to be worth when they're done fixing it. That's how we get comfortable with the product. So for most deals, if they're buying it right and they're going to make a nice profit on the home, we're perfectly comfortable funding 100% of those rehab dollars. Typically, we do it in 3 draws as the work progresses. And we'll fund up to 85% on the purchase. And then what we'll do is we'll underwrite it not to exceed 75% of the as repaired value. Once again, 12 months, 75 to 2.5 minimum, 2.5 million, FICO of 600. We do like the borrowers to have some experience, but it is not mandatory. So let's go through the numbers. So once again, you have a purchase price of $100,000. This particular renovation, they're going to put $30,000 into the product. 680 on the credit score, which is very solid. Nothing wrong with that at all. This particular borrower flips about 5 properties a year. Qualifies for the as repaired value program. It's a 12-month loan, 85% of purchase, 100% of the renovation costs. We're going to do an $85,000 mortgage at closing with an additional $30,000 in rehab holdback. So what that means is we're funding $85,000 to whoever they're buying it from. Borrower comes in with $15,000 out of their own pocket, and we will fund the entire $30,000 in holdback. $115,000 would be the maximum amount RCN will lend. We would cap it at 75% of ARV. Down payment is $15,000, closing cost $10,000, 2 points. Borrower receives the $85,000 to buy the property. The full $30,000 rehab would be held back in 3 draws, 10 each. Now, as far as the draws go, we really leave it up to the borrower. We're not interested in pigeonholing the borrower to some specified benchmark. If they want to do 3 draws, great. They want to do more, there's a draw inspection fee of $125. We have no problem with that. Draw issued upon receiving the inspection that shows the renovation is approximately 1/3 complete. Remaining draws will be issued when each phase of the renovation is complete. Property needs to appraise for $153,500. So that's really the number we're looking for. That's the number that we need to get to make sure this borrower is making money. If the as repaired value is not $153,000, not a good loan. So once again, just to reflect back on how this product works, it's not about the borrower. It's really not. It's all about the asset. It's whether or not this customer is going to make money on that particular renovation project. And I'm not going to spend a lot of time on this, but as the single-family home market across the nation has improved, many folks are beginning to hold houses for rental income. So we rolled out a 3-year short-term buy-to-rent loan. It's popular, but not nearly as popular as the fix and flip loan. So just to go through it real quick, property value must be at least above $75,000. Once again, non-owner occupied. We'll do, for this product, condos, townhomes, and we'll look at small apartment buildings as well. What for this product, how we underwrite is we want to see that the rent coverage ratio is at least 1.25, above what their expenses are going to be. So let's look at the loan to value in the bottom right. Lesser of $75,000 as is, up to $75,000 loan to cost. On a purchase, on a refi, up to $70,000 as the as-is value, and cash out, once again, up to $65,000. These values are a little bit higher because there's income being produced by this property. A little bit about RCN. We're a lender in 48 out of the 50 states. We're not in South Dakota and Minnesota. So let's talk about reputation for a minute. Reputation in any business is everything. Whether you're selling sandwiches on Main Street, preparing someone's tax returns, or originating loans for your customers. Your reputation is everything. And at RCN Capital, we started this company back in 2010 with an idea. And the idea was to take hard money out of the shadows and professionalize it. Make it a legitimate business. And that's what we've done. We started very humbly on the East Coast, originating loans out of Connecticut. But the idea was to build a brand where customers could come, have their loans funded with the same respect and dignity as if they were going to a regular, traditional commercial bank. But all of the nonsense that the traditional commercial banks put their customers through to get a simple loan would be removed. Now, that doesn't mean that we're making loans willy-nilly, but we are making loans with common sense underwriting. It's capitalism at its best. And what I mean by that is, if the borrower is going to buy a home, fix it, and sell it, and make money, let's just require the items to make sure that they're going to make money and take everything else and get rid of it. And that's really what we've done. Your reputation as an independent professional is just as important as RCN's reputation is to me. I know that if we do right by our mortgage brokers, you will do right by us. And I can't tell you how important that is. Being paid at closing, having monies wired to your account off the HUD, simple things like that don't happen in the hard money world, is the way that we do business at RCN Capital. And we're very proud of that. So, let's go through some examples of deals that we funded, and this will probably kind of spark some questions, and we'll leave some time at the end to have a good question and answer session. Okay, so here is a single family home in Louisiana. This particular deal, there was an it was an $81,000 purchase and rehab loan. It was a partnership. There were two real estate investors that were going to fix and flip this property. The project consisted mostly cosmetics. More often than not, most loans, even today, are mostly minor fixes. People go in and they take out the vinyl flooring, they put in hardwood, get rid of the dated countertops, put in granite. Maybe a new roof, certainly new paint. It's unbelievable what these simple cosmetic fixes can do for a value. In states such as California, we're seeing more additional square footage being added. The property values have gotten so crazy, really the only way to get a good return on your investment is to add some square footage, and we're happy to do that. So we were able to do an 80% purchase on 100% of the rehab. The borrowers purchased the property below the as-is value, and once again, when we order these appraisals, we're looking at the as-is value, and we're looking at the as-repaired value. The borrower provides that scope of work to RCN, or you, the mortgage professional. We provide it to the appraiser, and that's how we determine what the after-repaired value is going to be. This was a 2-point deal. Broker earned 1 point on this deal. Okay, here is a condominium in Washington, D.C. This was a very experienced borrower. This project needed a great deal of work, as you can see by the pictures here. We quickly funded this loan at 74% of the ARV, and we covered 100% of the renovation costs. Once the project was complete, the borrower was anticipating a 12% return. So in the hotter markets, California, Texas, definitely Washington, D.C., Miami, New York, 12 to 15% is really the type of return that most of these investors are making today. The days of buying way under value and getting a 25, 40, 50% return are long gone. But when you're buying a $500,000 property, a 12% return ends up being a pretty good chunk of change. The broker on this earned $8,398 in fees from this deal. It was a very profitable loan. Borrower made out great. Okay, here's one in a single-family home in Colorado. This was a buy-to-rent. So we had a very experienced investor here who already owned multiple rental properties in several different markets. I don't know if any of you folks are from Colorado, but Colorado is one of the hottest markets in the country. It's unbelievable how good it is right now. We provided a 24-month loan at 67% LTV. The investor had a tenant lined up, moved them right in. Broker earned $3,450 on this particular deal. Here's one outside of Portland. $270,000 purchase and rehab loan. This was a first-time investor, so a lot of folks get nervous about first-time investors, and at RCN, we do scrutinize the rehab list with a little bit more clarity on first-time investors, but we are comfortable making loans to first-time investors. This borrower planned to spend about $40,000 in renovations prior to listing this property for sale. We provided a loan at 70% of the ARV. So when first-time investors oftentimes will scale back that 85% of purchase down a little bit, just for a little bit more security. The Portland area is super hot right now, and this house, since we went to press with this, it's already sold. We've been paid off. Broker earned $2,700 in fees on this particular deal. So I spoke about reputation, and I just want to stress again that we look at our brokers as partners in what we do. Without independent mortgage professionals, we really don't have a business at all. We need folks like yourselves. We trust that relationship. Our loan officers become very close with their referring brokers. You will be on a first-name basis with someone at RCN Capital. And it was by intention that we designed it that way. No matter how big our company got, I never wanted to take out that personal service from the folks who are building our business with us. We want to help you have another product in your arsenal, but by the same token, we want that service to be there for you, so when you're selling a product to your customer, you can feel confident that you're doing right by your customer. And it really is a trickle-down effect. So that is our presentation. I intentionally leave time at the end for questions and answers. So I'm going to open it up, and we'll get started. Yes? Do you require one general contractor for the renovation cost? So the question is, do we require one general contractor for the renovation? And the answer is no. Many of our borrowers GC these products themselves. Many of our borrowers participate in the work themselves. We do have an internal system for vetting out their rehab list, but we do not require that they have just one general contractor overseeing the operation. Yes?
Do you have to have a contractor in the program?
Sure.
Can it just be the person rehabbing
Sure. So the question is, do you have to have a contractor or can the borrower do the work themselves? And the answer is no, you do not have to have a contractor. Many borrowers GC the product themselves and then actually help them do some of the work as well. Now, when we're dealing with a customer that is doing multiple flips, that's not the case. Typically, they have a general contractor, they have it all vetted out, and it's a very repetitive process, but we do not require it. Yes? Sure. So let me take the first question first. And the first question was, is there any fees up front to originate these loans? And I don't put that into the presentation, but I probably should, because it is a point of pride for RCN Capital that there is no upfront fees for us to look at deals and underwrite deals. If we don't close a loan, we actually lose money because we have decided that there will be no application fees, title. Outside of the appraisal, we don't collect a nickel until the closing table. And it's by intention that we did it that way. I never wanted your customers to come back to you and say, you know, they charged me $750 to look at this deal, and then they turned it down. What's that all about? That is a conversation that will never happen with RCN Capital. And it really is a point of pride. Okay, second part of your question is construction draws. How do we look at them, and how do we disperse the funds? And what happens if there's not enough money? So internally, we have a construction review team that looks at every single deal when the borrower provides the list. We know when specific markets are inflated, not to the nickel, but we have a pretty experienced team that vets those rehab lists, and we have a good idea of what those items are going to cost in specific markets around the nation. We have a pretty sophisticated software solution as well as an independent team internally that looks at every list. Internally. Sure. So the question is, do we have inspectors that go out? So in the draw process, as I stated, usually it's 3 draws. So we have a team, it's an independent company, that goes out, takes pictures with the customer or contractor or whoever is running the job, reviews that work that's been done so far, and provides a report to us. It's like $125. Once again, I don't care how many draws they want, they're paying for the draws. So we get that report back and we see how far along they are in the project. We try to do it in thirds, but that's how we determine. As far as what happens if they run out of money, cost overruns. This happens from time to time. And what we usually do with the borrower is, if something went wrong and the value of the home is intact, which usually it is, we will look at doing a modification and adding some monies to that loan to finish up the project. We're not in the business of making our customers' lives difficult. We just want to get the job done, and that's how we handle it. So let me parlay off of that before I take the next question. So what happens if the borrower runs out of time? Our loan is a 12-month loan. What happens if, for whatever reason, they don't have the project sold? We will absolutely do a modification without any sort of penalty. I mean, they're going to have to pay an interest and origination. by the way, that borrower, well, let me finish this and then I'll get into that. But that borrower, as long as they're in good standing with their payments, haven't missed payments, will absolutely do a modification to get them. Now, we're also going to have a conversation with them about what they need to do to get that property done quickly. So the question is, what about interest reserves? We do not do interest reserves at closing unless they're using cross-collateral. So sometimes borrowers have properties that have little or no mortgage on them, debt equity. We'll do a cross-collateral situation. We'll pull some cash out of there. We'll set up an interest reserve, and they can actually go to closing with little or no money out of pocket with that collateral. Right. The interest is monthly only. So two things. Let's talk about the interest for a second. There's a number of lenders around the country that have made a business out of charging folks what we call in the industry full boat interest on the entire loan. What does that mean? That means if I make a $100,000 purchase loan and a $50,000 rehab for a $150,000 mortgage, there's a number of lenders around the country that begin charging interest from the day you close on the full $150,000. To me, it's unconscionable. I don't know how you charge your customer for money that they're not even using and haven't even begun to access yet. RCN Capital only charges interest on monies that are actually dispersed and the customer is using. If you should have private lenders that you're currently doing business with, or you should have other private lenders who are asking you to send them business, the first question you should ask is, are you charging my customer on money that they don't even have access to yet? It's unconscionable. Second item, your customer is your customer forever at RCN Capital. What do I mean by that is, some customers think, well, I'll just go with the broker and I'll go to RCN, I'll get set up, and then next time I'll go back to RCN and I'll get cheaper pricing because I don't use the broker. No. Whether the broker deals with that customer or not, that is your customer for life. You will be compensated on every loan going forward with RCN Capital. It is your customer, and that's the way it's just the right thing to do. Next question. Yes, sir.
Okay, you mentioned that you have experienced people who are going over the list of what it's going to be, see if it's inflated. You don't have people who are maybe first or second time. What if they give you a list that you can see from your experience that it's actually underinflated? Do you inform them and help them with it?
Yeah, so that's a great question. What happens when the rehab list looks light? There's not enough money to do what they're saying to do. And actually, that's really a bigger concern for us than the list being inflated. The list inflated is the borrower's just trying to get more money to try and float the project. The scarier item is the borrower not understanding what they're getting themselves into. So what'll happen is we'll kick the rehab list back to the loan officer. Loan officer will talk to the broker or the customer directly and say, hey, listen, internally, we think you're light, and this is probably what you need to get the job done. It's a good conversation to have up front, because going back to your question from before, you don't like to have to do modifications if you can avoid it. There was a, yes, sir. Sure. So the question is exit strategy, and how do we vet the folks who are going to buy and hold? So by far, the fix and flip products are our number one product. People buy, fix, sell. But as I mentioned, some people are holding these properties for investment income longer term. So that gives us another, I'm not going to call it a concern, but another item of due diligence when we're underwriting these loans. When I say I don't really care if they paid their Macy's bill and they have a 600 credit score? I really don't, as long as they're selling the property. But if they're going to hold this property and have to go get a longer-term conventional loan, we are going to have to look at that credit report with much more due diligence. The number typically is 670 for most folks to get a traditional loan for investment purposes. But unfortunately, we have to have tough conversations with folks sometimes when they think they're going to be able to refi out, and they're not gonna, it's just not gonna happen. And you know, you guys, you have the well, I'm gonna get my credit score up, and I'm gonna, yeah. It's very difficult to get your credit score up in 6 months. So that's a tough conversation that we do have to have when folks are buying and holding. There was a gentleman in the back, yes?
Do you guys do scrape and build or just fix it?
I'm sorry, sir.
Do you do scrape and build or just fix it? They're gonna buy a house and do scrape and build.
Okay, so the question is just fix and flip or scrape. So for us, we'll look at any sort of non-owner occupied deal as long as it makes sense. That's really what it comes down to. It's all about, is the borrower going to make money? We'll look at any of them. Yes, sir.
I was just curious about the cost. You mentioned that the cost in some of your slides might be as much as $10,000. So in Northern Cal, average cost for title escrow appraisal is $2,000, $2,200,
Sure.
something like that. And then two points,
Yep.
$2,500 is $4,500.
Yep.
Where's the other monies? I mean, there's inspections for 125. Just curious, is it always 10? Can it be less? How does that break down?
Sure. So the question is, how do the closing costs all add up? In one of the slides, it gave an example of $10,000. So very simply, all the costs are outlined directly on the HUD. What are those costs? So you have cost for title work, as you stated. You have a cost for closing the loan. Usually it's like between $500 to $750. That pays for the attorney to close the loan and represent RCN Capital. And then after that, it's origination fees. And that's really it. There's no made-up fees. You know, some lenders like to title review and then printing, and the fees that they make up are quite comical. But it's not funny to the borrower. Ours are very transparent, and there is no made-up fees. Yes?
Do you have in your own in-house title that you work with, or you just use a regular neighborhood title company? Is everything that's handled inside your company, or?
Sure. So the question is, how do we handle title? Is it all handled internally, or do we allow the borrower to get their own title? And the answer is, we let the borrower do their own title work. Many of these real estate agents are connected somehow with a title company. We don't get involved in that. As far as closing the loan, we have our own in-house closing team, so we represent ourselves, and then typically you're going to go out and with the local title company and just close like that. Yes?
Besides marketing directly to mortgage brokers, what are you doing ahead of your competitors?
So the question is, besides marketing to mortgage brokers, how does RCN separate itself from other competitors? So it's interesting. I mentioned that we funded over 75% of our loans we paid a referral fee on. And that's by intention. We've chosen to work with outside referral sources. It was a business decision, and it's one of the best decisions we ever made. Having independent people represent RCN Capital and selling our products, it really separates us from the pack. They're putting loan officers in every city around the country, selling our product retail is not something that we're interested in doing. And I think it really differentiates us from everybody else. Yes? So the question is, do we require personal guarantees? And the answer is yes. So these loans are typically closed to an LLC. They don't have to be. We will lend to individuals directly. Why a borrower wouldn't put the property into an LLC is always a mystery to me, but For whatever reason, some borrowers don't. But we do require a personal guarantee either way. Oh, and on that, foreign nationals, we welcome. We're going to lower that LTV down because we waive the personal guarantee on foreign nationals, as, you know, it's of no use to us. But foreign nationals are welcomed, and we lend to them on a regular basis. Loan to value. I'm sorry? So instead of 75, we're going to lower it to 65. The answer is, would we waive the personal guarantee to a U.S. citizen for a lower LTV? And the answer is yes. And let me explain to you how that often comes into play. Many folks, as the real estate market has improved, have begun using their retirement accounts to draw cash out and put into a non-directed funding situation. If you do that, you can't commingle and you can't not sign a personal guarantee for those assets. So that's one particular case where we do that on a regular basis. Correct, correct. There was a question over here. Yes? The question is, do we lend to mortgage brokers? Well, they're the most upstanding citizens of all. Why wouldn't I lend to them? No, absolutely. It's interesting because mortgage brokers and real estate agents are often the ones that are closest to the good deals. So often times they're in the game. So yeah, we welcome those customers. Hi. Sure, so the question was, what are the interest rates and what happens if you have to do a modification? Do the interest rates change? So first off, interest rates start at 7.99. In California especially, there is a super competitive market for fix and flip as well as rehab lending. Most of our loans in California go out between 8 and 9%. In the rest of the nation, it's usually between 9 and 10%. The lower the interest rate, the more experience that you have. And that's the way we price it. Somebody who has done multiple flips are much less risk to us, and we will give them a better interest rate. Second question is, do the interest rates rise on the modification? On the first modification, the answer is no. We do not raise the interest rate. We do charge another origination fee to write that loan again, but we do not raise the rate. However, if we have to go to a second modification, we do reserve the right to bump that interest rate up. I don't like to do it. I don't like to put the borrowers in a bad spot, but they need to realize that they need to get that product sold one way or the other. It becomes a bad situation for the borrower as well as the lender. Yes? So for the fix and flip program, is there a FICO that we would not lend against? And the answer is yes. We do run credit reports, and we do see sometimes scores come back in the high 4s, and you got to work really hard to get a 480 credit score. So the answer is yes. If we see credit scores that low, the borrowers are really blowing up somewhere in their life right now, and we will not lend to them. I'm just going to take one more question. I got to turn the room over. Anybody else? Well, that was it. I'm going to head back to the booth. If anybody has any more questions, thank you so much. Enjoy Las Vegas.
This is Mortgage News Network.